Imagine two people, same age, same salary, same city. One of them retires at 55 with enough money to never work again. The other one is still grinding at 67, wondering where all the years went. Same income, completely different outcomes. Here's the thing. The difference wasn't how much they invested. It was the order in which they did it. Most people think investing is just about picking the right stocks or finding the hottest mutual fund. But the truth is, there's a specific sequence, almost like a cheat code, that quietly determines whether your money multiplies or just disappears. And almost nobody teaches it. Today, we're going to walk through that exact sequence, step by step. And by the end, you'll know the smartest order to put your money to work, so every rupee you save does the maximum possible job for you. Here's a mistake I see constantly. Someone gets their first real paycheck. They're excited. They open a trading app, buy some stocks, maybe throw some money into crypto because their colleague won't stop talking about it. They feel like an investor now. But meanwhile, they have a credit card sitting quietly in their wallet, charging them 36% interest per year. Think about that for a second. They're hoping their stock picks return maybe 12 to 15% a year. But their debt is eating them alive at 36%. That's like trying to fill a bathtub while the drain is wide open. This is what happens when people invest without a system. They skip steps, they go out of order. And the result is that their money never really builds. It just circles the drain. The problem isn't motivation. Most people want to build wealth. The problem is that nobody ever gave them a map. So today, let's build that map together. Think of your money like water flowing through a series of containers. Each container has to fill up before the water flows to the next one. If you skip a container, water spills everywhere and you lose it. Here are the containers in the right order. Step 1. Build your emergency fund first. Before you invest a single rupee, you need a financial cushion. 3 to 6 months of your monthly expenses sitting in a simple liquid account, a savings account, or a liquid mutual fund. Now, here's the psychology behind this. Most people skip this step because it feels boring. There's no excitement in a savings account, no dopamine hit, no story to tell at a dinner party. But here's what actually happens when you don't have an emergency fund. Your car breaks down. Your job suddenly feels unstable. A medical bill arrives. Then what do? You sell your investments, often at the worst possible time, just to cover the emergency. Your emergency fund isn't a boring choice. It's the foundation that keeps everything else standing. Without it, every investment you make is built on sand. This is where most people feel the psychological pull to invest instead of paying debt. The market feels exciting. Paying off a loan feels like punishment. But that feeling is a trap. High-interest debt is the single most destructive force in personal finance. Kill it first. Step 3. Claim your employer match if you have one. If your company offers a PF contribution match or any retirement benefit where they match what you put in, that is a 100% instant return on your money. Day 1. You put in 500 rupees, your company puts in 500 rupees. You've already doubled your money before the market even opens. This is the closest thing to free money that exists in personal finance, and yet a shocking number of people don't fully utilize it, simply because they never understood what it meant. If this option exists for you, use it fully, always. Step 4. Invest in tax-advantaged accounts. Now we're flowing into wealth-building territory. In India, instruments like ELSS mutual funds, PPF, and NPS give you real tax benefits while also growing your wealth over time. Think of tax savings like a discount on your investment. If you're in the 30% tax bracket and you invest in a tax-saving instrument, The government is essentially co-investing with you by letting you keep money you would have otherwise paid in taxes. This is the step where the math starts getting genuinely exciting, because now you're not just earning returns, you're earning returns on money that would have gone to taxes anyway. Step 5. Invest broadly for long-term wealth-building vehicles. After the above steps are handled, now you take any remaining investable money and put it into long-term wealth-building vehicles. Index funds, diversified equity mutual funds, assets that grow with the economy over decades. This is where the real compounding magic happens. But here's the key insight. Compounding only works undisturbed. Every time you panic and sell, every time an emergency forces you to withdraw, you break the compounding chain. That's exactly why steps 1 through 4 exist. They protect this step. They make sure your long-term investments can actually stay long-term.
Why order matters more than amount. Here's the idea that most financial content never talks about. Wealth isn't just about how much you invest. It's about the architecture of how your money is structured. Think of it like building a house. You don't put up the roof before the walls. You don't decorate before the foundation is set. There's an order, and if you violate it, the whole thing becomes unstable. The same is true with money. Investing in equities while carrying high-interest debt is like decorating a house that has no foundation. It looks like progress, but one storm, one job loss, one medical emergency, and everything falls apart. Here's the deeper psychological truth. Most people make money decisions emotionally, not architecturally. They chase what feels exciting right now. They avoid what feels uncomfortable. And so they end up with a portfolio that's scattered, unprotected, and constantly being rated for emergencies. The smartest investors aren't necessarily the ones with the best stock picks. They're the ones who built their financial architecture correctly, so their money was protected at every stage before it was deployed for growth. There's a reason the wealthy get wealthier over time. It's not just about income. It's that their financial structures are stable. The foundation is solid. The containers are filled in the right order. And so wealth compounds without constant interruption.
So what should you actually do with this? Start by taking a piece of paper or open your Notes app and answer these 5 questions honestly. Do I have 3 to 6 months of expenses saved in an easily accessible account? If not, that's your first job. Do I have any high-interest debt above 10 to 12%? If yes, that's your second priority. Am I claiming every rupee of employer match available to me? If not, you're leaving free money on the table. Am I using available tax-saving investment options before investing in regular accounts? If not, you're paying more tax than you need to. Only after those 4 boxes are checked, then and only then, should you focus purely on growing your long-term investment portfolio. This isn't a complicated system. It's actually beautifully simple. It's just that most people never got it presented in the right order.
And here's what happens when you do follow this sequence. Your financial life starts to feel stable for the first time. Not exciting in the short term, but deeply secure. And from that security, wealth actually starts to build. Quietly, consistently, compounding year after year without being constantly interrupted.
I want to leave you with one thought. Most people spend their entire lives working for money. The truly wealthy spend their lives building systems where money works for them. The difference starts with something as simple as getting the order right. You don't need a higher salary to start. You don't need a hot stock tip. You don't need to take big risks. You just need to fill the containers in the right sequence and then be patient enough to let compounding do what it does best.
The 2 people we talked about at the beginning, they started in the same place. The only real difference was that one of them had a map and followed it in the right order. Now you have that map too. If this gave you clarity, share it with someone who's just starting out, because the best time to learn this was 20 years ago. The second best time is right now. I'll see you in the next one at the Asset Avenue Club.